Hello there, this is James and you're watching Tixee Live. In fact, you're watching Tixee Live presents #Ask James. Now this series obviously is slightly different from the normal Tixee Lives and the watch-alongs because these little episodes or these little videos are for education. Okay, and the idea is you sending a topic of your choice or a subject you'd like me to cover, and I dedicate a whole live video just for that topic. Now, before we get started, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, there are risks at hand before entering any trade. With that out of the way, let's get started. Like I say, so this is the latest episode of Tixee Live, #Ask James. And today's topic is a topic I've studied for a long time, and I find it's extremely important to know, but so many newbie traders out there don't take the time out to learn about it, which I think is a mistake. So today's topic is about currency correlations. Big thanks to viewer Arthur56 for this topic suggestion, and I really, really appreciate it. And like I say, keep your ideas and keep your topic suggestions coming in. So let's get started. What is currency correlations? Well, first of all, before we get into that, let me go through today's agenda. So first of all, we're going to go through what is currency correlations. Then we're going to go how to understand currency correlations. Then we're going to talk about negative and positive correlations. Then we're going to look at the currency correlation table. Then we're going to be going through using currency correlation to monitor your exposure, very important, and how currency correlation can help in your trading. So let's get started on it. So first off, what is currency correlation? Currency correlation is a statistic measure of how two assets move in relation with each other. By looking at a currency correlation, traders can see whether two currency pairs move in the same direction or the opposite direction. Traders can also see if there is no correlation at all between all different currency pairs. So they can see if there is a positive correlation or a negative correlation or no correlation at all. When you are trading more than one currency pair, it is vital, and I must stress, it is vital for you as a trader to be aware of how different currency pairs move in relation to each other. This is not just important to spot potential opportunities, but also very important because this is a way how you can control your exposure in the market. Obviously, I'll go more into that in a moment. So, moving on. This is really important. This is how we all work it out, okay? And this is correlation coefficient. Okay? So, what is it? Basically, it's a range between -1 and +1. Now, the perfect positive correlation is +1. This indicates that two currency pairs move in the same direction almost 100% of the time. A perfect negative currency correlation, okay, is -1. This indicates that two currency pairs will always move in the opposite direction. Zero correlation indicates that the two currency pairs have no relationship with each other whatsoever, and they move random with each other. Now, to break this down a little bit more, okay? Now, this is a table, okay? So we got -1 on one side, negative correlation, and +1, positive correlation, and 0, which is neutral, okay? Means there's no relationship. So the closer the number gets to -1, the more negative correlated that currency pair is. The more closer to +1, the more positive correlated that currency pair is. Now, how to understand this and to check on this, what you then go and use is what's known as a correlation table. And let me explain and show you an example of one of these, okay? So this is a correlation table, all right? So we've got obviously Aussie dollar, US dollar, Euro Swiss franc, Euro sterling, Euro dollar, Japanese sterling Japanese yen, which is obviously the guppy, cable British pound, US dollar, dollar Swiss, dollar yen, and gold. Obviously, I'm going to have to put gold in there. And as you can see, we've got a range of numbers here, range of numbers. Now, the boxes, which are dark blue, shows that that currency pair, for example, is positively correlated. So if we have a look, for example, if you look at the euro dollar, okay, so the number there is dark blue and it's 0.9116. Look across the table to the currency pair we're comparing it to is the Aussie dollar, US dollar. So it's saying basically that is positively correlated with each other. So which means they can move most of the time in the same direction. Okay, if we look across and choose another one, the dark red, okay? Dark red is negative, and it shows that it's negatively correlated. So if we look, for example, let's compare, say, the British pound Japanese yen, okay? Move 3 boxes in across, okay? We can see it's the euro sterling, and it's negative, a dark red color. It's negative 0.8544, so it's negative, so it's close, so it's negatively correlated. Hey to you too. How you doing? You okay? Hope you're well. I hope you're well. So as you can see, so that's negatively correlated. So this is what you look at. So the closer to -1, the more negative correlated it is. The closest to the +1, the more positive correlated it is. The medium, like I say, if we compare the median, for example, let's say, this looks like, choose a pink one. Let's say, for example, the British pound Japanese yen. If you go across, 1, 2, 3, 4, 5, 6, 7, 8 boxes in, up above is the dollar Swiss franc, it's negative 0.3674. So it's not that close to -1. So though it's still negatively correlated, it's not a strong negative correlation. Okay? So that's how you read the table, and that's how we use it. Now, why is this important? Why is this useful, knowing if they're negative correlated or positive correlated? Because it's extremely useful. And I'll explain to you why. First of all, it's really useful because it can help you control your exposure. Now, this is why it's extremely useful. Now, if we have a quick look here, let's do some examples, okay? Let's have a look. The dollar, the euro dollar, best friends with the sterling. Sometimes, or most of the time. Let's have a look at the table again. Let's have a look. Let's have a look, see how positively correlated the euro dollar is with the British pound US dollar. So let's have a look. Euro dollar, okay, so let's go along with the British pound. There it is, okay? Dark blue, 0.7079, so close to +1. That means then it is positively correlated, which means they tend to follow or go in the same direction. Let's have a look at an example here. Here we go. This is the euro dollar and the British pound US dollar, okay? We've got the euro dollar on the left, and we've got British pound US dollar on the right. Now, can you see a pattern there? And the euro dollar is falling, so too was the British pound. When the euro dollar was recovering, so did the British pound. Now, of course, there's mortal enemies as well, negative correlated. Let's have a look now, for example, euro dollar, dollar Swiss franc. They don't get on, do they? Or do they? Let's have a look. Euro dollar. Go across. Dollar yen. Sorry, dollar Swiss franc, 0.8229. So it's negative negative 0.8299, meaning it's negatively correlated. That means they're going to go in the opposite direction. Let's have a look at an example. Let's have a look. Okay, euro dollar on the left, dollar Swiss franc on the right. When the euro was falling, what was the dollar Swiss franc doing? It was rising. When the euro dollar started to recover, what did the dollar Swiss franc do? It was falling. So it's negatively correlated. So they'll go in the opposing directions. So, okay, we've explained this. So that makes sense. But why is it useful? Why is it handy? How can it help you? How can it help you? Okay, well, first off, it can help you several ways. Okay, number one, it can stop you being counterproductive with your trading. For example, let me give you a scenario. For example, you've got a euro dollar long position in the market. At the same time, you have the dollar Swiss franc in the position. You've longed both. Now, as we already know, they tend to move in opposite direction. So maybe you were making profit on the euro dollar because you got the direction right. Because the dollar Swiss is going down, it's basically wiping out your profits on the euro dollar. So it's controlling your exposure. So you're actually, instead of just randomly trading pairs, which you think could go either way, because they're negative correlated, they wipe each other out. So that's why it's important. Exposure and opportunity. Okay, here's another example, another scenario. Euro dollar, as we've already established, is good friends a lot of the time with the British pound US dollar. So say, for example, you've longed the euro dollar and you've longed the British pound US dollar, thinking that you're on two separate you're trading two separate pairs, but you haven't. Because they're correlated, they're actually doubled your exposure. You've got two currency pairs which are not related, but they are positively correlated. So say you're losing on the euro dollar, you potentially be losing as well on the British pound US dollar. You're doubling your exposure. Diversify, same story, okay? Same story. You can say you're bullish on the dollar. You believe the dollar is going to go up in strength. So you want to short the euro dollar. So you're going to do two lots. But instead of, shorting two lots on the euro dollar, you can diversify by shorting the euro dollar and the cable, the British pound US dollar. Why? Because they're positively correlated. So if you got it right and the dollar is weak and the euro the dollar is strong and indeed the euro starts to fall, the sterling, the British pound US dollar will also start to fall. So that's another good example of how correlations work. Another thing, hedging. You can give yourself a potential hedge. What does that mean, James? For those who are new to trading, hedging in currencies is basically when you're take almost like an insurance policy out on a trade. So say you've got one position in the market, you open another position to give yourself a bit of protection in case you're wrong in your analysis and where you think that pair is going to go. I'll give you an example and we'll go back and have a look at this. Let's look at the euro sterling and the British pound Japanese yen. Let's go back to our little table this quickly. Are they friends? Are they friends? Okay, so there's the euro sterling, third down. And there's the guppy, British pound Japanese yen. So that's 1, 2, 3, 4, 5, 6 boxes in. Dark red, negative 0.8544. So they're negatively correlated. So that means they're going to potentially go in opposite directions. Okay, so what can you do to hedge yourself? And what do you mean? What I mean by the hedge? So like I say, let's have a look at the chart actually, so we can see ourselves. Okay, here we go. So this is the euro sterling. Okay, there it was going down. Okay, let's look at the guppy. At the same time, it was going down. Okay, it was also moving higher. The guppy was moving higher. So a point of a hedge, what you could do, again, and I will stress, correlations is not always 100% right as well. And we'll talk about the risks of correlations and the risks, okay? Now, for example, you've studied the euro sterling and you're bullish on the euro sterling. You think the euro sterling is going to go up, okay? But you decided to protect yourself just in case you're wrong. As we know, the British pound, Japanese yen, and the euro sterling are negatively correlated. That means they'll go in opposite directions. What you do is this, Okay, you say you do a potential long on the euro sterling, but a larger position, because that's what you've studied. At the same time, you do a long on a smaller position on the British pound, Japanese yen. So if you're right, okay, the euro sterling position will be in a profit. Your British pound, Japanese yen will be in a loss, but the loss, because it's a smaller position, will basically still means you're in profit. At the same time, if you're wrong and the euro sterling starts to fall and the guppy starts to go up, then of course you make some profit on that, which means you don't lose all of your euro sterling position. Make sense? But here's the thing, and I must stress this, because this is not financial advice. This is not financial advice at all. This doesn't always work. This does not always work, okay? Because correlations can change and different things can factor in. What might be moving the euro sterling at one matter, they might have some breaking news in Japan, for example, affecting the yen. So you need to be aware of that, okay? Because in trading, nothing works all the time, okay? It's not always works all the time, but otherwise it'd be extremely easy. But trading is not easy. So you always need to be aware of the risks and always need to be able to protect yourself. Finally, the other thing to talk about, confirmation, knowing confirmation. So say, for example, euro dollar is moving higher and is testing testing a key resistance. Okay, and so is the sterling. At the same time, the dollar yen and dollar Swiss franc are moving low. Now we know euro dollar and sterling dollar are positively correlated. And we both know those pairs are negatively correlated with the dollar yen and a dollar Swiss franc. So if you see confirmation that the euro dollar is moving and the British pound is moving higher, and both the Japanese yen pair and the Swiss franc, or dollar yen and dollar Swiss, is moving lower, that gives you confirmation, indeed, that you have a weaker US dollar. On other things, though, if you're seeing a euro dollar moving higher, but the sterling is actually just not moving that dramatic, and the dollar yen is basically range trading, and the dollar Swiss franc is range trading, means the euro dollar has been affected by potential news maybe coming out of Europe or something affecting that pair in particular. Okay, there is no confirmation. So again, that can give you the idea of making sure you can avoid potential fake breakouts. And this is also something extremely important. Okay, currency correlations can change. They can change all the time. So you need to be aware of this all the time. So keep updating yourself on the correlation table. And even though, like I said, something might be heavily positive or heavily negative, doesn't mean it's always going to act in that way. Doesn't mean it's going to act in that way. So this is where, obviously, you always need to trade with caution. Okay, there's no magic answer. So always be aware of that. The only way to basically keep yourself up to date on the currency correlation is keep updating yourself on the table. Looking over a period of time. A lot of correlation tables, which are available out on the World Wide Web, so you can get it for free. But they will update themselves, okay, and you will be able to see a weekly time frame, so how long they've been correlated in a weekly, daily, 30-minute, 40-minute, an hour, etc. So you can actually even choose your time frame as well. So they're out there. Hello there, George. How are you? Yes, it's a big fan, man. I'd like to get to know you, though. You can get to know me, George. Hope you're well. Hope you're good. Nice to see you. What was I going to say? Was that actually to me, or was that to SMF? Anyhow, good to see you. Right, what was I going to say? So yeah, it's out there, so it's always good. It's always good to keep yourself updated and make sure you're aware of the correlations. Anyway, is there any questions in relation to this topic, or any questions in any other questions? Or anybody else like to get to know each other? Not to worry. Don't forget, if you think of a question later, you can always put it in the comment section, either on YouTube or Facebook. I will see them, and I will reply to them next time I go live on air. Next episode of #AskJames, I will be doing next week, probably on the Friday again. So, keep sending your topic suggestions. And don't forget, you can add a topic in the comment section here on the chat, or you can add the suggestion in the comments on YouTube and Facebook, etc. And I'm happy to get it. And like I say, a big shout out today for today's topic for Arthur after 56, wasn't it? Big shout out to you. Good man. Thank you ever so much for your suggestion. I really, really appreciate it. Because don't forget, these little episodes are all for you. You know, I can't do them unless you can send me your ideas and what your suggestions are. Once you can send your suggestions in, then I will promise I will do an episode on that as well. And like I say, this is an introduction. So this, like I say, it's not a massive full-blown webinar. For that, I do it for the trading school episodes, which I do on a Wednesday night. So bear in mind. This is a really big topic. It is a very big topic. It is, George. It's massive. I mean, like I say, it's a huge topic, which, like I say, this is only an introduction. When I do the trading school episode, which goes on for an hour, over an hour, and I do it with a colleague of mine on a Wednesday night, I will be doing this subject again. But that time we'll be going into a lot more detail, like being aware of, like I say, when you see the positive correlation not working and understanding the reasons for it. And understanding how the relationship with the different pairs can alter and can change, and what the market is focusing on in particular. So that's going to be something. So yeah, we'll be doing a big episode on that really, really, really soon, and like I say, this is just an introduction today, just to give you a little bit of an intro, like a little by baby steps into it, because there's so much more to go into it, so much more. Okie doke. So yeah, keep your suggestions coming in. Anyway, did anybody find? Did everybody found this useful? Did they enjoy the episode, or do you have any other questions on it? Or do you have any questions totally, maybe relate to the market or anything like that? Anything else? I mean, what topics would everybody else like me to cover? Any ideas? What you'd like me to discuss in the future? So I switch from my coffee to water now. Okie dokie. Okay, if there is no further questions or no other comments, big shout out to George Dillon. Thank you ever so much for your contribution and for coming along. Shout out to, as always, one of the regular viewers, SMF 790. Thank you for coming as well. I really, really do appreciate it. And a big shout out to all of you, obviously, of course, for coming along today. And I really appreciate it. And I hope you got something out of this little episode. Anyway, don't forget, I'll be back online again later today, round about just before 3 p.m. UTC, to discuss what's going on in the US session. Another normal Tixie Live episode, see what's going on. Hopefully, I won't need to talk about Twitter, because I think I've talked about that enough. But anyway, till next time, don't forget, if you're watching me on Facebook and you enjoyed this little episode, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little episode, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this little video, found it useful and interesting, by all means, give me one of these. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.